Do you realize how important realization is to the income tax? I'm Allison Christians.
And I'm Leandra Letterman, and it's time to break into tax. We have a shorter version on the topic of realization, and this is the extended cut for those who want even more about the realization doctrine.
Realization is a really simple idea on the one hand. It's just a trigger to say, oh, wait a minute, you have to think about your income tax right now. Something happened. When you work for a paycheck, receiving the paycheck is the trigger, realization of income. But what if you get paid in stock? The moment you get paid, you own something, but now the stock goes up. Did you get paid a little bit more when the stock rose in price? No, because of the realization idea.
You own your house. Maybe you own an investment property and the value goes up and you may feel wealthier. And you might even be able to borrow against that increase and increase your liquidity as a result. And does that mean that you have gross income? No, because of the realization requirement. It's well accepted that something that simply makes the income tax more administrable. Because if we didn't have a realization requirement, the idea would be that paper gains and losses could be taxed on an ongoing basis. And we have that mark to market in some limited contexts. But if we didn't have the realization requirement, then what that would mean would be that taxpayers would be getting deductions for those paper losses. And it would take a lot of enforcement resources for the IRS to audit taxpayers to really assess what is the value that the taxpayers' assets actually have. It's much harder to establish the amount that should be subject to taxation if you don't have some triggering transaction. So usually what triggers realization with respect to a gain or loss is some kind of disposition.
As soon as you realize that realization is a trigger, then you can imagine that taxpayers are going to spend time balancing. I want the trigger, I don't want the trigger. So I'm going to do things to trigger in some cases, for example, if I might have a loss, and I'm going to wait. I'm going to hold off. I'm not going to pull the trigger if I have a gain.
In the US system for gains and losses, the realization calculation is in Code Section 1001. It's on the gain side, the amount realized less the taxpayer's adjusted basis produces gain realized. And on the loss side, it's flipped, that the amount by which the adjusted basis exceeds the amount realized is the loss realized. So Section 1001 is just a mathematical calculation. It tells you the amount of the profit or loss that the tax system has deemed to have occurred. And then recognition is how much you'll actually be taxed on of that. When do you apply Section 1001? You have to have some kind of sale or exchange or other disposition.
In Canada, we have proceeds of disposition where you have a sale or exchange or other disposition where you go and you just do that mathematical calculation, just the same as in 1001.
The Treasury regulations in Section 1.1001-1A talk about exchanging for something materially different in kind or extent. So you have stock and you exchange it for cash, or you have stock and you exchange it for a painting. Those are examples of realization events, and we have a market transaction typically. And so it makes the tax much easier to administer than if we simply said, well, we're going to have to value everybody's stock holdings, whether they're publicly traded or not, at the end of the tax year or on their birthday or something like that.
You have a great paper that talks about this valuation issue, which we'll link in the description below.
One important concept for students is that realization is a necessary but not sufficient condition for taxation. It's a prerequisite. You have to have that in order to have recognition, meaning it's taxed, shows up on a tax return, but it's not in itself a sufficient condition because you still might have some kind of non-recognition provision applying even once there's realization. One context in which I remind students of it is that when you get to non-recognition transactions, so you're doing more esoteric transactions like kind exchanges or merger and acquisition transactions, you cannot end up with an amount of gain or loss recognized that's greater than the gain or loss realized. And sometimes, students look at the amount of boot and it's large and they end up with a large gain recognized amount. And it's no, we have a realization requirement. If only $10 of gain was realized, you can't have $30 of gain recognized, because effectively you're violating the realization requirement.
In Canada, you would sometimes see those non-recognition provisions called rollovers. I think that's something you might see in US history, right?
Yeah. So for example, old section 1034 used to have rollover of gain on the sale of a principal residence, and it was a non-recognition provision. That's been eliminated, and Code Section 121 was amended, and so we have a different system for that now. But yeah, that is a context where we also called a non-recognition provision a rollover, because of the idea that you were taking the gain on one asset and you were investing it into a replacement similar asset. Same issues on the loss side, that just because you have a moment where you realized a loss, that does not necessarily mean that that loss is recognized.
Exactly.
It's not necessarily deductible. And that's particularly true for, at least in the US system, for individuals. You realize a loss on the sale of your personal residence or your personal car or some other personal asset. Well, individuals' personal losses are just not deductible. They're not authorized.
The taxpayer's desire to trigger losses, to trigger realization of losses, is exactly what leads you to a bunch of loss limitation rules, right? So it's the fact that the taxpayer has control and they can trigger the loss and then, maybe buy the stock back again the next day. So we need a wash sale rule, right? So we need a loss limitation rule. We're cabining things. When you're thinking about realization, the intuitive moment when realization matters is when you're thinking about something that has been rising or falling in value and you exchange it. And that's why we often associate realization with gains and losses. But realization through exchange or disposition of an asset is not the only way to realize income in an income tax. There are these other ways as well. For example, a cancellation of debt can be a trigger, a realization trigger, because the obligation to repay is no longer there. And that's the trigger that says, oh, now you have to realize that income, which is the money you got from the debt you no longer have to repay. The realization rule is ubiquitous. A windfall is a realization event in the United States. It is not in all countries. It is not. But it is in the United States. The windfall event itself, the finding of treasure trove itself, is the trigger. It's the realization trigger. Income in Canada has to have a source. So it's not enough to have an accession to wealth, because the accession to wealth has to be from a productive source, something that is capable of producing income. I think the Cesarini case is exemplary of why realization is not intuitive. Most people would not think, I found something, I now have to pay tax on it. They would not think, oh, I've had a realization event, until you tell them, well, actually, that is a realization event. That's a trigger, and you have an obligation now to consider the tax implications.
So from a US perspective, one of the major early cases on the realization doctrine is Eisner versus Macomber. And the law has really evolved since then. But I think that background is helpful in understanding the doctrine, which is that in that case, Mrs. Macomber got a stock dividend, which is more shares of stock for her stock holdings in the company, which was Standard Oil Company. So she was a common stockholder. She got more shares of common stock, but so did everybody else. So her proportionate ownership of the company did not change. And that is not a realization, according to the US Supreme Court. That idea that you have to have something materially different in kind or in extent, like the Treasury regulations say, is reflected there. If you had 5 pieces of paper reflecting a certain percentage ownership of a company, and now it's 10 pieces of paper reflecting the same ownership of that company, that's not a material economic change. And so there's no realization event. It would be different if you exchanged those shares in that company for shares in a different company, for example, like you might do as part of a corporate merger or acquisition. And that M&A transaction might turn out to be tax-free, but it's still a realization event. There's a non-recognition provision that might apply, but it's still a realization event.
Yeah, so it's not really tax-free, right? It's tax deferred. The realization trigger, if we know that taxpayers are going to want to either pull the trigger or not, and that they have control over that, then you can imagine right away your tax system is going to have problems because you have debt, you have interesting financial instruments that can help you recreate a realization event without having an actual realization event. So you can bypass the realization rules with some interesting and fancy financial footwork. The idea of debt is, well, when I lend you money, the reason you don't have income is because at the very moment that I lent you money, you incurred an obligation to repay it. So there's no realization. But what if I let you off the hook and I say you don't have to pay me back anymore? Now we have this really non-intuitive idea that all of a sudden you have something, realization. So with a deduction, it's the flip side of an income item. On the income side, you have received or accrued. On the expense side, you have paid or incurred. If you're an accrual method taxpayer, as soon as you incur an obligation, realization, you go look for that deduction allowance. Sometimes you can see realization pop up in unexpected places. For example, an imputed interest charge on a loan that is 0 interest or too low. You know, you might think that's an anti-abuse rule, and it is, but it's also forcing a realization of a return before the end of the investment. If the tax system sort of forces you into a realization event with a kind of a fiction like imputed interest or a deemed dividend, for example, then the tax system also has to give you credit somewhere so you don't then realize it again later. And how do we do that? Well, we do that with basis. So it's super complicated, and we'll get to basis in a later video, but it's good to know now that when you see little funny little rules and you sort of dig into them a little bit more, often you're going to find that there's a realization issue, and realization, it's a trigger for the taxpayer, but it's also a trigger for the tax system. It's going to pull in a whole bunch of different rules to kind of true things up. You're going to start to learn about patterns in an income tax class. And this is just one of those patterns. Oh, something happened. Does it trigger realization? And then you'll train yourself to say, okay, but realization is not recognition. Realization is a moment where income has been created in the sense of an income tax, but it doesn't necessarily mean that tax is owed right away. So then you're going to go look for those exceptions to recognition. And I think that's pretty universal. You might see different words in different income tax systems. We don't necessarily use exactly the same terms in Canada as we do in the United States, but the idea is very consistent across systems. As soon as you realize how much value we are bringing to you as you break into tax, I hope you'll like our videos and subscribe to us on YouTube.